Okay, hello everybody. Market Michael here. Now, markets have just tanked today. We are gaining some support around these levels here. The comps sold off much more than the rest of the indices. Actually, the Dow is actually sold off technically percent-wise more than the comp, but we are gaining some support here just at the fact that we have dipped so low. You know, I want to say that there's still extreme potential for us to continue this decline. Well, you know what? No, we are going to continue this decline. I just am not sure at how it's going to. You know what I'm saying? For instance, this is a 30-minute chart we're looking at, a 15-minute, 5-minute. So, you know, for this, we are getting slightly more, we're at 7, and this MACD histo is at -9. So we're close to almost being maxed out on this 30-minute. I still expect us to, we could end up getting support here at this level. Let's look at an hour chart. Okay, ready guys? So what happened here when we were bouncing in underbought? Well, we had a spike up, and that was a turn of bullish momentum. So, probably we're going to continue to go down a little bit, maybe until this point. So we're going to float along, maybe just get support around here, finish the day at that moment, you know, possibly Wednesday we'd come up a tiny bit here. Wednesday, oh well, this is a couple days going up. So, and then this was after a big decline. Huge gap down these 2 days. So, yeah, let's see. What are we looking at? So, again, this was a rough day. I said we were going to dip down. We dipped down, but then we shot right back up. A pretty unexpected that end of day move. You know, so anyway, we're continuing the downtrend. Absolutely a bloody battle. Uh, you know, anything's possible. We could just keep spiking along the bottom. Um, we could, this could turn into a bullish movement. A quick bullish movement Wednesday, Thursday possibly. GDP comes out Friday, market tanks. That's what I'm looking at. That's what I'm looking at. We had a really, really bad day today. We had, almost 2% drops and counting. I'm pretty sure that these markets will continue to go down. We are getting a little bit of support here. We may bounce a little bit, but I don't see too much support here. I mean, now we're going to fall to this 6,800 level, and that's going to be near that 200-day moving average. We'd bounce above it, right? Bounce above that 200-day moving average, but then it's just a little technical bounce, and we are finally going to sink through it, guys. This is finally it. These are the last warning calls, guys. The last warning calls of this bear market. Yield curve is in the danger zone below that 0.5% region, that where anytime it has gone down below that region, it has not come back up until we've inverted. So we have gone into the danger zone, right, for yield curve. We have gotten weak GDP numbers. We have year-over-year declines. Um, we do have mixed numbers. For instance, this housing debacle, because the numbers say that we have um, numbers show that we do have an increase in that, a decrease in the supply. So that is making it so people would it's gonna have effect in supply and demand. When there's less supply, that's going to increase the price. Um, and right now, the Northeast is doing as well as, let's say, the South or Midwest. So what's that tell you? That's because it's cheap to live out there. The Northeast is expensive. I'm sure it's the same thing in California or something. Those markets are going to get bid up because the people who live there generally have money. Northeast is very rich. I live in Bergen County, one of the richest counties in the United States. So it's all the areas bought up to as much as possible, and I don't know if the markets or the housing markets can withstand extreme high prices, because these people, not only are they moving out of these extremely big homes, McMansions as we call them, they're moving out, and people are renting. More people are renting. There's less single family home starts, and there's you know more people are renting. Um, we just got some data from the Fed saying, um, let me just sign in to my account here. But new single family home sales top forecasts. I guess especially because the mortgage rates are like 4% plus. But here we go. Richmond Fed manufacturing sinks to -3 versus 16 expected, lowest since September 2016. And this was due to weakness in new order volume, which dropped from 17 to -9, with shipments tumbling to -8 from 15. The employment component rose to 12 from 11, with wages jumping to 27 to 22. Prices paid edged up to 2.43% pace from 2.39% pace, though prices received slowed to 1.46 from 1.54. The 6-month shipment index fell to 39 from 55, with new orders sliding from 36 to 36 from 46. Though employment rose to 34 from 31 and wages at 47 from 42, the future price trend showed a dip in prices paid to 2.57 from 2.59. So what happens in a deleveraging scenario? Well, people are unable to spend money. So what happens now is people have to pay their debts. So they have to pay their debts, but they're not as many people are going out to bid up the prices of goods. And this so when you have that happening, now manufacturers have to produce less, right? They have to produce less. They have to lower the cost, guys. They have to lower the cost. Why? Because people aren't bidding up prices. There isn't enough demand, and it looks like that's what we're seeing at the moment. It's not enough demand. Well, this recession is going to happen. I'm definitely forecasting it for sure. We are in a bear market. A bear market doesn't necessarily mean a recession, but a bear market is the start of economic disaster when the Fed relies on the wealth effect to keep everybody happy and wealthy. It's and the market goes down. Well, what's that do to the wealth? That makes it turn to nothing. Um, you know, what are we looking at right now? We are looking at the fact that we are probably going to fail these levels of support and continue to head lower. This 15-minute does show a weakening of some strength, but I don't think we're going to actually manage to hold here. I think we're going to continue to make these losses uh, into the close unless we're done here. If we're done for the day, then we're going to have a little bounce. We have that little bounce. We come back down and we fall through those 200-day moving averages. But what makes more sense is for us to fall down now because we would actually directly test this 200-day moving average. There's only 200 points between us and the 200-day moving average. So we'd get, let's say, if we go down another 100 points, we'd be at 69.30. And that's close enough for the markets to shoot back up, reset a little bit, and then come back down and absolutely tank through it. There in markets you can't just go one way or the other. Again, we are at the tip of the iceberg on this 1 minute and failing. It looks like that's what we're going to do. So for this chart, this Nasdaq chart, we're looking at a 6900 pullback, maybe 6950 pullback. For this S&P, we're looking at let me get the stockcharts.com, guys. Again, all we need is another 100-point drop. Get real low. We have a fake bounce. Bounce to 7100-ish. Fail it and tank through it. Tail of the tapes. Although this daily chart shows that we're just going to tank through it and not bounce at all. I mean, we could even bounce in after hours. Again, we are just continuing to fall. This 2600 mark provides the 200-day moving average, which will be tagged very soon. And finally, the Dow Jones Industrial is only 400 points away from testing that 200-day moving average, which it will fall through. So right now we are bouncing. It looks like at least here. So we've finished up a second leg here that is going to give us some distance from this support range. So, this bounce is going to happen now. Guys, this bounce is going to happen now. It might not actually. The 15-30 minute still look awful. I think these are just technical bounces. Now, again, if we continue this negative pressure here, we're going to send this next candle into a bearish candle and continue this downward movement towards the 2600 level and towards this 36,000, no, 30, so I'm so sorry, 23,600 level. I'm pretty sure. And look at that, we are getting a negative candle, which should escalate rather quickly. Let's look at different time frames. I'm sure this video is rather long here. We're at a 15-minute video, guys. So on a 10-minute, we are kind of getting the gist that we have bottomed, but this is a transition candle, so we need to confirm that we want to be here. Now let's look at a more small time frame to get a better picture of what's going on. So a 3-minute shows us, again, we are at the top of the range like I said before. We are kind of peaked out, so all I suspect is for us to fail this support line, continue this move lower, bounce off that 200-day moving average. It's going to shoot back up, but let's see. I don't think it's going to break resistance and it's going to fall through that 200-day moving average. This is going to be revolutionary. This is going to change everything. We are in officially a bear market. When we do this, we're going to break lower lows on all the indices. Meanwhile, gold had an $8 rally today. It's coming off the highs. We got Bitcoin kind of just floating at the medium price range it was at. Seems to always be bid up, though. Well, I have a phone call coming that I have to answer, so with that being said, everybody, I will see you around 3 o'clock, maybe even before that. So thank you very much. Please like and subscribe, and I will see you later.